Hello friends, we'll be discussing another illustration which is again a comprehensive problem related to ratio analysis. So now that we are familiar with the different kind of ratios that we have to deal with, we'll now be going ahead with some advanced kind of problems which will have more of ratios to be figured out, which will have certain missing numbers as well. So let's start with the illustration so that we can go ahead and understand how to find out the missing figures if other ratios are already provided to us. So the question has been provided to us. There is a lot of assumption here, and apart from that, we have to find out the missing figures. So unlike the other usual ratio problems, this isn't the same. There's certain things that are different here. Let's figure out what exactly they are. It has been given in the question that we have to assume that a firm has an owner's equity capital worth rupees 1 lakh. There are certain ratios that are already provided to us, like the ones that has been mentioned down here. Current debt to total debt is 0.4 times, or rather 0.40 is the ratio. 0.40 is to 1 will be the exact ratio for this. Total debt to owner's equity, that means the ratio of total debt and the owner's equity is 0.60 is to 1. Fixed assets to owner's equity ratio is somewhere again mentioned down here. That is again 0.60 is to 1. Total asset turnover is 2 times, and inventory turnover mentioned here is 8 times. So now there is a balance sheet that has been provided down there. We have current debts, we have long-term debts, we have total debts in the liability side, we have owner's equity as 1 lakh, and total equity that we have to figure out. Similarly, on the asset side, we have cash, we have inventory, we have total current assets, fixed assets, and total assets. So all these missing figures is what we have to find out using the ratios that has been provided up there. Now we'll be doing one simple thing. Whatever data has been provided to us, we'll take that and we'll see which all formulas can be used to figure out all of these items, because you need to take one item at a time and figure out whether this owner equity can be a part of this. So owner's equity 1 lakh, which has been already provided, using that instance or using that as a variable part, whichever formula you find owner's equity as 1 lakh and the second variable can be found out basis on this, we need to figure that out. So let's use that thing. So now when it comes to the solution, we understand that we have given so many ratios, but there is one ratio which states total debt to equity. If you see, that is the only ratio that we have down there. So if you can see, we have mentioned down equity value is 1 lakh rupees. Now in all those ratios, we have fixed asset to equity, total debt to equity, for which ratio has been already provided. That means that will be debt to equity ratio and asset to equity ratio, out of which we'll be able to find out what is the total of fixed asset and what is the total of total debts here. Let's take an example here. So the ratio that has been provided, that is 0.60 is to 1, which is total debt to equity. This is the ratio that is provided. If there is nothing down there, that means 0.60 upon 1 is what we can assume. Now in this you have equity value given there, so you can find out the total debt. Whatever has been provided, that is owner's equity, that is 1 lakh, has been mentioned in blue. Now you can just cross multiply and see what is the total debt that comes up. So the total debt that has came up here is 60,000 rupees. It's a simple cross multiplication that we have done. We'll mark this as the first point, that is, we'll highlight it as A. Similar way, we have fixed assets to owner's equity. Again, the same kind of formula that we'll be using, and then we'll be figuring out how much is fixed assets. So if you can see, we have mentioned down there fixed asset upon equity. The value of equity, that is 1 lakh, has been also mentioned there, is equal to 0.60 upon 1, because that is the ratio that has been provided. We'll do the same calculation, that is cross multiplication, and figure out how much is the fixed asset here. So we have figured out the value of the fixed asset, that is again 60,000. So that has been done here. We have marked it as B. Now, if you have to figure out the total equity, so total equity's formula here is owner's equity plus total debt. I believe we have both the numbers, that is owner's equity, which is 1 lakh, and total debt, that is 60,000, which we just figured out as a part of A. So we have figured out total equity as well, which is 1,60,000 now. Now let's figure out what else can be done using all these three values. When it comes to total assets, we have another aspect here. Total asset equals to current assets and fixed assets. That is what all we have. So out of that total assets, we have fixed assets for 60,000, which we have figured out, and current asset is what we have to find out. Now, before we could find out the total assets, let us understand one thing. Total equity means the total of the liability side is 1,60,000. That means total assets should equivalent to 1,60,000. It should be equal to 1,60,000. This is what you're assuming. If I'm correct, because liability equivalents to asset side, and hence the balance sheet tallies. So total assets equals to current assets plus fixed assets. This is the formula. If the total liability or the total equity is 1,60,000, that means total asset should also be equivalent to 1,60,000. We have mentioned it in green so that we can know that it's an assumption of ours. We have fixed asset as 60,000 already mentioned, already figured out. So if the total asset is 1,60,000, out of which fixed assets amount to 60,000, so the balance 1 lakh is the current asset that we have figured out. Let's box the same thing. Now in total, we have finalized 4 values here. Let's prepare an interim balance sheet and see where the balance sheet stands together. So in this interim balance sheet, owner's equity is 1 lakh, which has been already mentioned. Hence, we are mentioning it in blue. Rest, whatever we have found out right now, we'll be mentioning it in green. So total debt which was a part of A, that means it was denoted as A, 60,000 was the amount, has been mentioned there. Fixed assets which were found out, which were denoted as B, 60,000 was the amount there, we'll mention it there now. Next, total current assets. Total current assets being a part of D, that means it was denoted as D, which was 1 lakh rupees. Total assets which was figured out was denoted as C, that is 1,60,000. Total equity which was found at as 1,60,000 has been also mentioned there, denoted as C. So if you can clearly see, the total equity is the total of liability side, and the total of assets on the asset side is the total of complete asset side here. That means total asset is the complete total asset. Subrogation, or rather when we do a segregation of it, it is divided into current assets and fixed assets. Now inventory and cash is again a part of fixed asset and current asset, or rather we can talk about current assets itself. Now whatever, if you see inventory and cash, that is supposed to be find out, let's cross mark them. So the total of cash and inventory will be equivalent to the total current assets here. And the total of current debt and long-term debt will be the total of all total debts. So total debts, whatever amount it is, it will be equivalent to the current debt and long-term debt here. So that is the missing figure that we have to find out. Wherever the cross mark red is, that is something that we have to find out now. So let's do that. Now that we have the interim balance sheet prepared, wherever cross marks are there is what we'll be finding out. Now the first option that we'll be doing is that the current debt will be found out, because we have the ratio there 0.40. Current debt is to total debt has been given as 0.40 is to 1. So let's use that. This is the total ratio that has been provided to us, out of which total debt is something that we already have. So now we can figure out the current debt here, that is cross multiplication again. So we figure out the current debt total, which is coming to 24,000. It has been denoted by E. Now let's figure out what else can be found out here. Now that the current debt has been found out, we can actually find out what is the long-term debt. So next item will be long-term debt here. So the formula for total debt is current debt plus long-term debt. We already know what is the total debt, that's 60,000. We found out the current debt, which is 24,000. Long-term debt is something that we have to find out. So whatever the difference between them is, 60 minus 24 will give you long-term debt. So 36,000 is the long-term debt that we have figured out. We have denoted it as F. Let's prepare the interim balance sheet again and complete the whole liability side, after which we'll have to only figure out only the asset side here. So whatever we have figured out, we'll mark it in blue, rest will be in red. So if we see total debt, that is 24,000 plus 60,000, or rather 24,000 plus 36,000 will give you a total of 60,000, which is equivalent to the total debt. That's what we actually meant. Now Liability side has been already prepared, asset side is supposed to be filled in. Now that we've prepared everything here, cash and inventory is the only thing that we have to figure out. Let's see if the ratios help us out in getting all these two details. Now there are two ratios that are provided to us. One is the total asset turnover ratio. Next is inventory turnover ratio. Asset turnover ratio basically. So the formula for asset turnover ratio is sales upon asset. Sales we have no idea, but assets we do have an idea about it. And the ratio is also provided, which is 2 times. So total assets is amounting to 1,60,000. So sales upon 1,60,000 is equal to 2. So total sales will be 2 into 1,60,000. We have found out the sales is 3,20,000. We have denoted it as 1. Now this thing will be used for inventory turnover ratio. Inventory turnover ratio formula is looking something similar as it is in time. So let's find out what is the formula for inventory turnover ratio. So inventory turnover ratio is basically sales upon inventory. Now either of it is something what we already have, that is sales amount. Now that equivalence to 8 times is what the ratio is saying us. So we figured out the inventory as well, which is amounting to rupees 40,000. That is 3,20,000 divided by 8, which gives you an amount of 40,000. Now, out of that cash and inventory, if you figured out one amount, which equivalents to, because cash and inventory together will comprise of total current assets, which is already 1 lakh. So if current assets, total current assets is 1 lakh, inventory is 40,000, the balance will be cash here. So let's figure that out. Well, this formula total current assets is equal to inventory plus cash is because we only have these two items as part of current assets. Hence, only these two items are mentioned here. So cash has been figured out as 60,000 here. With this, we have completed all the items. Let's prepare the final balance sheet. So with this, we have completed the illustration. We have figured out all the items that were missing in this balance sheet. So that means if you have one item out of this, you have to relate that one item of the balance sheet to every possible formula and then figure out which formula is the best one to find out the other variable, and accordingly you have to go ahead with that pattern. So this is how you produce, or this is how you finalize the answers for missing formulas or other missing answers in a balance sheet using the formulas of ratio analysis. So I hope this illustration was interesting enough to make you understand how the formulas are supposed to be used, how the missing values are supposed to be figured out. So thank you for watching this video. Stay tuned with Ekeeda and keep subscribing to Ekeeda.